Have you ever wondered what separates the ultra-wealthy crypto traders from the rest? By the end, you will have a complete trading system proven to work in real markets by real professionals. For those of you who are completely new to crypto, we will start with the basics, although if you are already familiar with that, feel free to skip this part to the next timestamp. So what are the cryptocurrencies? Cryptocurrencies are digital or virtual currencies that use cryptography for secure financial transactions. They are decentralized, meaning they are not controlled by any government or central authority yet. Instead, transactions are recorded on a distributed public ledger, which is maintained by a network of computers around the world. Since the inception of Bitcoin, the cryptocurrency market has grown exponentially, with thousands of different cryptocurrencies now in existence. Some notable examples include Ethereum, Litecoin, Ripple, and Bitcoin Cash, each with its unique features and use cases. The key features of cryptocurrencies. Number 1. Cryptocurrencies operate on peer-to-peer network without the need for a central authority or intermediary. This decentralized nature ensures that no single entity has control over the currency, reducing the risk of manipulation or censorship. All cryptocurrency transactions are recorded on a public ledger called the blockchain, which is accessible to anyone on the network. This transparency promotes trust and accountability within the system. Cryptocurrencies leverage advanced cryptographic techniques to secure transactions and protect users' identities. This use of public and private keys, along with the complex mathematical algorithms, makes it extremely difficult for unauthorized individuals to access or manipulate the system. The most popular one is Bitcoin. It was launched in 2009. Bitcoin is the pioneer on cryptocurrency and remains the most widely adopted and valuable digital asset to date. It was designed as a decentralized digital currency and store of value. The second most popular crypto is Ethereum. Ethereum is a decentralized open-source blockchain platform that supports smart contracts and allows developers to build and deploy decentralized applications. Then we have a Litecoin, often referred to as the silver to Bitcoin's gold. Litecoin was created in 2011 as a faster and more efficient alternative to Bitcoin. It has a higher transaction processing speed and lower fees compared to Bitcoin. And then we have XRP. Ripple is a real-time gross settlement system and cryptocurrency designed for financial institutions and facilitating cross-border payments. Its native cryptocurrency, XRP, is used for settling transactions on the Ripple network. These are just a few examples of the many cryptocurrencies available in the market today. As the technology continues to evolve, new cryptocurrencies with unique features and applications are likely to emerge, further shaping the future of digital finance. Now we'll explore the foundational concepts behind blockchain technology, which underpins cryptocurrencies and has numerous other applications. Understanding blockchain is crucial for anyone looking to trade cryptocurrencies effectively. So what is blockchain? At its core, a blockchain is a decentralized, distributed digital ledger that records transactions across many computers in a network. Unlike traditional databases, which are maintained by a central authority, a blockchain has no single point of control or failure. Each transaction on the blockchain is grouped into blocks and cryptographically secured. As new blocks are created, they are linked to the previous block using a cryptographic hash, forming an immutable chain, hence the name blockchain. Blocks are like pages in a ledger, containing a permanent record of recent transactions. Each block has a unique identifier, a hash, the data for the transaction, and the hash of the previous block, creating an unbreakable chain. A blockchain network is made up of nodes, computers that participate in validating transaction, maintaining a copy of the ledger, and helping secure the network through a consensus mechanism. Since there is no central authority, nodes on the network must agree on which transactions are valid and should be added to the blockchain. This is achieved through a consensus mechanisms, proof of work or proof of stake. These mechanisms prevent bad actors from manipulating transactions. The first step on your crypto trading journey is, of course, setting up a crypto trading account. In the world of cryptocurrency trading, having a secure and reliable trading account is crucial. In this unit, we'll cover the essential steps to set up your account on two of the most popular cryptocurrency exchanges, Bybit and Binance. When it comes to selecting an exchange, reputation and security should be your top priorities. Both Bybit and Binance are well-established and reputable platforms with robust security measures in place. Before you can start trading on these exchanges, you will need to create and secure a cryptocurrency wallet. A wallet is a digital storage solution that allows you to store, send, and receive cryptocurrencies securely. For Bybit, you can use their built-in wallet or a third-party wallet like MetaMask or Ledger. It is recommended to use a hardware wallet like Ledger for enhanced security, especially if you plan to hold larger amounts of cryptocurrency. Binance also offers a built-in wallet. So as I said, securing your wallet is crucial. Follow best practices such as using strong password, enabling two-factor authentication, and keeping your recovery phrases safe and secure. Because if you lose your recovery phrases, you will basically lose the access to your wallet. Once you have set up your wallet, it's time to fund your trading account. Both Bybit and Binance offer multiple options for depositing funds. Bybit supports deposits in various cryptocurrencies, including Bitcoin, Ethereum, and USDT, which stands for USD Tether. You can transfer funds from your personal wallet or purchase cryptocurrencies directly on a platform using fiat cryptocurrencies like USD, Euro, or Pounds. Binance also supports a wide range of cryptocurrencies for deposits, as well as fiat currency deposits via bank transfers or credit or debit cards. However, fiat currency deposit options may vary depending on your location. When funding your account, be sure to double-check the deposit addresses and transaction details to avoid any mistakes. It's also advisable to start with a smaller amount until you become familiar with the process. Now, let's move to cryptocurrency trading basics. And we start with understanding order types. Order types are the instructions you provide to the exchange when buying or selling cryptocurrencies. They determine how your trade will be executed and can have a significant impact on your trading strategy. Here are the most common order types. First one is a market order. A market order is an instruction to buy or sell a cryptocurrency at the best available price in the market at the time of execution. These orders are executed immediately, but the price may differ slightly from the initially displayed price due to market movements and spreads. A limit order is an instruction to buy or sell a cryptocurrency at a specific price or better. If the market price reaches your specified limit price, the order will be executed. If not, the order remains open until it is filled or cancelled. So basically, if you want to buy something low or sell high, then you'd want to use a limit order. Example: a hypothetical cryptocurrency is trading at a price of 1500. Let's say you would like to buy this currency, but you want a better price. Let's say you would like to buy it for 1400. Then you place your limit order at 1400, and when or if the price ever drops to this place or lower, your order will get filled. A stop-loss order is designed to limit potential losses. It's an instruction to sell a cryptocurrency when its price drops to a certain level. These types of order can be used to automatically exit a trade if the market moves against you, helping to protect your capital. And then stop limit order. It's an instruction to buy or sell cryptocurrency at a specific limit price or better, but only after the market price has reached a predetermined stop price. To put it simply, it is the opposite of a regular limit order. So let's say if the price for a hypothetical cryptocurrency right now is 1500, but you would like to buy this cryptocurrency only if the price goes above 1600, that's when you use a stop limit order. If it doesn't make any sense now, believe me, it will when we get to that later in more detail. But basically, it is what breakout traders are doing. They buy the market on a breakout with a stop limit order, so they buy high to potentially sell even higher if the breakout is successful. And then we have a trailing stop order. A trailing stop order is a dynamic stop-loss order that adjusts itself as the market moves in your favor. It is designed to lock in profits by automatically moving the stop-loss level as the cryptocurrency's price increases. Now I suggest we move on to technical analysis part. Cryptocurrency charts are visual representations of price movements over time. They provide valuable insights into market trends, patterns, and potential trading opportunities. Understanding how to read and interpret charts is essential for making informed trading decisions. So we have a few types of charts. Candlestick charts are among the most popular and widely used chart types in cryptocurrency trading. Each candlestick represents a specific time period, like 1 minute, 1 hour, 1 day, etc., and consists of a body and wicks. The body represents the open and close prices, while the wicks represent the high and low prices during that time period. Now, line charts are simple representations of price movements over time, connecting data points with a continuous line. They provide a basic overview of the price trends, but lack the detailed information found in candlestick charts. Bar charts are similar to candlestick charts, but use vertical bars instead of candlesticks to represent price movements. Each bar displays the open, high, low, and close prices for a specific time period. And now let's talk about chart patterns. Identifying chart patterns is an important aspect of technical analysis. Patterns such as head and shoulders, double tops, double bottoms, triangles, and wedges can provide valuable insights into potential market reversals or continuations. So basically, technical analysis is the study of the past market data, primarily price and volume, to identify patterns and trends that can be used to forecast future price movements. It's a widely used approach in cryptocurrency trading as it relies on the principle that market movements are not entirely random but follow certain patterns that can be identified and exploited. And the first and most important tools of technical analysis is of course candlestick patterns. Candlestick patterns are specific formations of candlesticks that can indicate potential market reversals or continuations. Let's have a look at some of them. A doji is a candlestick pattern where the open and close prices are nearly identical, forming a horizontal line instead of a body. This pattern represents indecision or a potential reversal in market trend. A doji candlestick can signal a potential reversal in the trend as buyers and sellers are in equilibrium. However, its significance is often stronger when it appears after an extended uptrend or downtrend. A hammer is a bullish candlestick pattern with a small body and long lower wick, indicating that buyers regained control after an initial sell-off. A hammer pattern can signal a potential price bottom or a reversal in a downtrend as buyers stepped in and pushed price back up after an initial decline. A shooting star is a bearish candlestick pattern with a small body and long upper wick, and little or no lower wick, suggesting that sellers took control after an initial rally. A shooting star pattern can indicate a potential price top or a reversal in an uptrend, as sellers overwhelmed buyers after an initial push higher. An engulfing pattern consists of two candlesticks where the body of the second candlestick completely engulfs the body of the first candlestick. A bullish engulfing pattern is a potential buy signal as it indicates that buyers overwhelmed sellers and took control of the market. Conversely, a bearish engulfing pattern is a potential sell signal as it suggests that sellers overpowered buyers and gained control. A morning star is a bullish reversal pattern consisting of three candlesticks. The first candlestick is a long bearish candlestick, followed by a small candlestick, a doji that gaps down, a long bullish candlestick that closes above the midpoint of the first candlestick's body. A morning star pattern can signal a potential bottom and a reversal in a downtrend, as buyers regain control after an initial sell-off. An evening star is a bearish reversal pattern that is the opposite of the morning star. It consists of a long bullish candlestick followed by a small candlestick, doji or spinning top, and then a long bearish candlestick that closes below the midpoint of the first candlestick's body. So an evening star pattern can indicate a potential top or a reversal in an uptrend, as sellers take control after an initial rally. These candlestick patterns can provide traders with valuable insights into potential market reversals or continuations. However, it's important to note that candlestick patterns should not be used in isolation, but rather in conjunction with other technical indicators and analysis tools. So now let's take a look at indicators. Technical indicators are mathematical calculations based on price and volume data that can help identify trends, momentum, and potential entry or exit points. Some popular indicators used in cryptocurrency trading include moving averages, relative strength index, known as RSI, Bollinger Bands, and the moving average convergence divergence, known as MACD. Moving averages are one of the most commonly used technical indicators. They smooth out price data by calculating the average price over a specific period of time. The two main types of moving averages are simple moving averages, SMA, and exponential moving averages, EMA. For example, the 200-period SMA is calculated by taking the sum of the closing prices for the last 200 candles and dividing it by 200. Traders often use moving averages to identify the overall trend direction. When the price is above the moving average, it suggests an uptrend, while a price below the moving average indicates a downtrend. Moving average crossovers, when a shorter-term moving average crosses above or below a longer-term moving average, can also be used as a buy or sell signals, but not on its own. The relative strength index is a momentum oscillator that measures the speed and change of price movements. It oscillates between 0 and 100, with readings below 30 considered oversold and readings above 70 considered overbought. Example: the 14-period RSI is calculated using the following formula. RSI equals 100 divided by 1 plus RS, where RS equals average gain of up periods divided by average loss of down periods. In cryptocurrency trading, the RSI can be used to identify overbought or oversold conditions. When the RSI is above 70, it may signal that the asset is overbought and due for correction. Conversely, when the RSI is below 30, it may indicate an oversold conditions and potential buy opportunity. MACD is a trend-following momentum indicator that shows the relationship between the two moving averages of a cryptocurrency's price. It consists of two lines, the MACD line and the signal line. When the MACD line crosses above the signal line, it generates a buy signal, indicating that the momentum is increasing and the uptrend may continue. Conversely, when the MACD line crosses below the signal line, it generates a sell signal, suggesting that the momentum is decreasing and the downtrend may continue. Now, Bollinger Bands are volatility bands plotted 2 standard deviations away from a simple moving average. They consist of an upper band, a lower band, and the middle band, the moving average itself. The upper band is calculated by adding 2 standard deviations to the middle band. The lower band is calculated by subtracting 2 standard deviations from the middle band. In cryptocurrency trading, Bollinger Bands can be used to identify periods of high and low volatility. When the price touches or moves outside the upper band, it may indicate an overbought condition, and when the price touches or moves outside the lower band, it may suggest an oversold condition. Traders often look for price rebounds from the bands as a potential entry or exit signals. These are just a few examples of the many technical indicators available to cryptocurrency traders. It's important to note that technical indicators, just like candlestick patterns, should not be used in isolation, but rather in conjunction with other analysis tools and risk management strategies. Additionally, different traders may have different interpretations and preferences for using these indicators, based on their trading strategies and market conditions. For example, you can use it with support and resistance levels. Support and resistance levels are key price points where the market tends to react. Support levels represent areas where buying pressure tends to increase, while resistance levels are areas where selling pressure tends to increase. Identifying these levels can help traders make decisions about entry and exit points. I want to add a little tip for drawing support and resistance levels. Never stress about drawing it perfectly, because these levels aren't exact, so you can just eyeball it and you will be just fine. Now let's move to trend analysis. Trend analysis involves identifying the overall direction of the market, uptrend, downtrend, or sideways, and making trading decisions accordingly. Traders often use trend lines, moving averages, and other technical tools to determine the prevailing trend. While technical analysis focuses solely on the price movements themselves, fundamental analysis is all about evaluating the actual value and potential of cryptocurrency project. So for this lesson, I'm breaking down the core aspects of fundamental analysis every crypto trader needs to understand. First up, we have supply and demand dynamics. On the supply side, you will want to analyze the total and circulating supply of a coin, the inflation or minting rate of new coins over time, and whether the protocol does any token burns to reduce supply. Then on the demand side, you will look at things like the coin's real-world utility and use cases, adoption metrics like active wallets and merchant acceptance, speculative investment interest, and powerful network effects that accrue as usage grows. The relationship between these supply and demand forces is crucial. A crypto with a fixed or decreasing supply but increasing demand is a prime bullish recipe for rising prices over time. Next, you need to seriously evaluate the fundamentals of the actual project and team behind the coin. Study that white paper. Does it lay out a clear, defensible purpose and roadmap? How robust and innovative the blockchain technology itself. Assess the public team. Are they experienced pros you can bank on to execute, or a sketchy anonymous group? Keep tabs on any big-name partnerships or adoptions by major companies and platforms. You will also want to analyze the coin's token economics and distribution model. Does it make sense and align incentives fairly? And of course, understand how it stacks up against the competition and if it has compelling differentiation. A vibrant, growing community is another heavy buy signal that shouldn't be ignored. The stronger the grassroots interest and support, the better. Ultimately, the goal of this research is to identify the highest potential projects and value them accurately based on fundamentals rather than just pure speculation. The other major aspect of fundamental analysis is tracking news and market sentiment very closely. Stay wired into all the major happenings for any coin you are invested in. Regulatory developments, new product releases, exchange listings, funding rounds, and so on. Pay attention to a project's development activity and milestone progress too. A transparently busy team steadily shipping updates is super bullish. Then you will want to monitor overall market sentiment and social signals, the crowd's mood and opinions across crypto Twitter, Reddit, Telegram, and TradingView stuff. Analytics tools can quantify if commentary is overall bullish or bearish. Always remember though, sentiment usually gets more excessive at major price tops and bottoms, so learn to identify and potentially fade those emotional extremes. Finally, leverage on-chain data to see raw blockchain metrics like active wallets, transaction volumes, exchange fund flows, and whale wallet movements. This tells you the actual usage levels, complementing the off-chain sentiment. Now let's talk about risk management. In the world of cryptocurrency trading, effective risk management is paramount. The volatile nature of the crypto markets demands a well-defined approach to managing risks, as even the most promising trades can turn sour without proper precautions. In this unit, we'll explore various risk management strategies that can help you preserve your capital and increase your chances of long-term success. Position sizing and portfolio diversification. One of the most critical aspects of risk management is position sizing, which refers to the size of your trade relative to your overall portfolio. It's essential to strike a balance between taking on enough risk to generate meaningful returns while ensuring that a single trade doesn't jeopardize your entire portfolio. The common rule of thumb in position sizing is the 1% or 2% rule, which suggests risking no more than 1 or 2% of your total portfolio value on any single trade. This approach helps to mitigate the impact of any single trade gone wrong, ensuring that your portfolio can withstand potential losses. Another crucial strategy is portfolio diversification, which involves spreading your investments across different cryptocurrencies, trading pairs, and even different asset classes. By diversifying your portfolio, you reduce the overall risk associated with any single asset or market movement. This approach can help you weather market volatility and potentially capitalize on opportunities in different sectors or asset classes. Stop-loss orders are essential tools in the risk management arsenal of any crypto trader. Stop-loss order is a preset instruction to exit a trade at a specific price level, limiting potential losses if the market moves against your position. By setting stop-loss orders, you can effectively manage your risk exposure and prevent small losses from turning into a catastrophic drawdowns. It's important to note that stop-loss orders are not foolproof, as they can be subject to slippage during periods of high market volatility or illiquidity. Therefore, it's crucial to incorporate additional risk mitigation techniques, such as trailing stop losses, which adjust the stop loss levels as the trade moves in your favor, helping you to lock in profits and minimize potential losses. Another risk mitigation technique is position scaling, which involves gradually increasing or decreasing your position size based on market conditions and the performance of your trade. This approach allows you to manage risk more effectively by adjusting your exposure as the market evolves. A well-defined trading plan is a foundation of successful risk management. Your trading plan should outline your entry and exit strategies, position sizing rules, risk tolerance levels, and a clear understanding of your investment goals and time horizons. Developing a trading plan requires careful analysis of your trading style, risk appetite, and market conditions. It should be tailored to your unique circumstances and regularly reviewed and updated as necessary. Sticking to your trading plan is crucial, as it helps you to remove emotional biases and impulsive decisions that can lead to costly mistakes. Discipline and consistency are key when implementing your trading plan, as deviating from your predetermined rules can quickly erode your risk management efforts. Additionally, it's essential to incorporate risk management practices such as setting stop-loss levels, diversifying your portfolio, and employing position sizing techniques. By integrating risk management strategies into your overall trading plan, you can cultivate a more systematic and disciplined approach to trading. In conclusion, effective risk management is an indispensable component of a successful cryptocurrency trading. Technical analysis is the study of the past market data, primarily price and volume, to identify patterns and trends that can suggest future price movements. While fundamental analysis examines the intrinsic value of an asset, technical analysis focuses solely on the market's behavior and sentiment. In this unit, we'll explore advanced technical analysis concepts and tools used by professional traders to make informed trading decisions in crypto markets. Moving averages are one of the most widely used technical indicators, smoothing out the price data to better visualize the trend direction. We'll cover 3 key moving averages. Simple moving average calculates the average price over a given period, given equal weight to each data point. Exponential moving average applies more weight to recent prices, making it more responsive to current price movements. And weighted moving average assigns a higher weighting to recent prices, but in more gradual manner than EMA. Moving averages act as a dynamic support and resistance levels, with the price often bouncing between them during ranging markets. Key strategies include moving average crossovers. When a short-term moving average crosses above a long-term moving average, it signals a potential bullish trend. The reverse indicates a bearish trend. And moving average envelopes. Setting upper and lower bands around a moving average can identify overbought and oversold conditions for potential reversals. Identifying the overall trend direction is crucial in technical analysis. Momentum indicators measure the speed and strength of price changes, helping traders identify potential trend reversals and continuations. We'll focus on 2 popular oscillators. Relative Strength Index, aka RSI, compares the magnitude of recent gains to recent losses, providing a value between 0 to 100. Readings above 70 suggest overbought conditions, while below 30 indicates oversold conditions. And Stochastic Oscillator. It compares the closing price to the high-low range over a given period, also ranging from 0 to 100. Crossing above 80 may signal overbought conditions, while crossing below 20 could indicate oversold conditions. Momentum indicators are often used in conjunction with other technical tools, such as moving averages or trend lines, to confirm potential signals. Volume represents the total amount of trading activity and can provide valuable insights into market sentiment and the validity of price movements. On balance, volume adds a period's trading volume to a cumulative total when the price closes higher and subtracts it when the price closes lower, helping identify potential divergence between price and volume. Money Flow Index incorporates both price and volume data to identify inflows and outflows of money, generating values from 0 to 100. Readings above 80 may signal overbought conditions, while below 20 could indicate oversold conditions. And order books provide a visual representation of outstanding buy and sell orders at various price levels, revealing market depth and potential support or resistance zones. By analyzing the order book alongside volume data, traders can better understand market dynamics and potential price movements. So, putting it all together, advanced technical analysis combines multiple indicators and tools to create a comprehensive trading strategy. For example, a trader might identify the overall trend direction using moving averages and trend lines, then confirm the trend's strength using momentum oscillator like the RSI or stochastics, analyze volume data and the order book for potential divergences or market depth confirmations. Set entry and exit points based on the combined technical signals with stop-loss orders to manage risk. As with any trading strategy, it's crucial to backtest and practice with advanced technical analysis tools before applying them in live markets. Now, let's move to trading strategies and techniques. This unit will delve into three main areas: day trading strategies, swing trading strategies, and position trading strategies. So day trading involves opening and closing trades within the same trading day, aiming to capitalize on short-term price movements. Here are two popular day trading strategies. Scalping is a high-frequency trading strategy where traders aim to profit from small price movements by opening and closing multiple positions throughout the day. This approach requires constant monitoring of the markets and the ability to act quickly on price fluctuations. Scalpers often employ technical indicators such as moving averages, Bollinger Bands, and support and resistance levels to identify potential entry and exit points. Range trading involves identifying a security's trading range and attempting to profit from its fluctuations within that range. Cryptocurrencies often exhibit periods of consolidation where prices oscillate between well-defined support and resistance levels. Range traders aim to buy near the support level and sell near the resistance level, capturing the price movements within the range. Unlike day trading, swing trading and position trading involves holding positions for more extended periods, ranging from several days to several months or even years. So swing trading focuses on capturing larger price swings by identifying trends and trading in the direction of those trends. Swing traders may use a combination of technical analysis tools such as chart patterns like head and shoulders, triangles, moving averages, and momentum indicators to identify potential entry and exit points. Position trading is a long-term strategy where traders aim to hold positions for extended periods, often months or years. This approach is typically used by investors who believe in the long-term potential of a particular cryptocurrency. Position traders may employ fundamental analysis, studying the underlying project's development, adoption, and use cases to determine their investment decisions. Let's have a look at automated trading strategies. In the fast-paced crypto markets, automated trading strategies implemented through bots and algorithms have gained significant popularity. These automated systems can execute trades based on predefined rules and conditions, removing human emotion and ensuring consistent execution. So trading bots are computer programs that automatically execute trades based on the predefined strategies and rules. These bots can monitor the market 24/7, identify trading opportunities, and execute orders without human intervention. Popular trading bot platforms for cryptocurrencies include CryptoHopper, Hasbot, and 3 Commas. Trading algorithms are more advanced and customizable than bots. They involve writing code to implement complex trading strategies, incorporating various technical indicators, risk management rules, and backtesting capabilities. Traders can develop their own algorithms or use pre-built solutions offered by trading platforms or third-party providers. When implementing automated trading strategies, it's essential to thoroughly backtest and paper trade the strategies before deploying them with real capital. Additionally, risk management techniques such as setting stop losses and position sizing should be incorporated to mitigate potential losses. Now I want to talk about the most underrated and slept on aspect of the trading. It is trading psychology and mindset. Successful crypto trading isn't just about technical analysis and market knowledge. Having the right psychological mindset is critical. Trading is an inherently emotional endeavor with the constant fear of missed profits or potential losses. Developing the proper mental fortitude and cultivating the right psychology will help you stay disciplined, manage your emotions effectively, and avoid self-sabotaging behaviors that can derail even the most experienced traders. One of the biggest challenges traders face is controlling their emotions. The crypto markets are highly volatile, with prices capable of soaring or plummeting in a matter of minutes. It's easy to get caught up in the excitement of a rally or the anxiety of a crash. Here are some tips for keeping your emotions in check. Greed and fear are the two main emotional drivers in trading. When the markets are rising, greed creeps in, pushing you to stay in positions too long or take on excessive risk to maximize profits. Conversely, when the markets start dropping, fear takes over, prompting you to exit positions prematurely or freeze up completely. Learn to recognize these emotions when they arise and have a plan to counteract them. Cultivate an even, unemotional mindset when trading. View each trade as a calculated decision based on your strategy and risk management rules, and not as a personal victory or defeat. Detach yourself from any single trade's outcome. Maintain a trading journal to document your thought process, emotions, and the reasoning behind each trade. Reviewing your journal can help you identify emotional patterns and biases affecting your decision-making. Discipline and patience are vital for successful trading. Without them, you will struggle to follow your strategy consistently and resist the temptation of overtrading. Having a well-defined trading plan is crucial, but sticking to it is even more important. Your plan should specify your entry and exit criteria, risk management rules, and position sizing guidelines. Follow your plan religiously and never deviate from it based on emotion or gut instinct. Overtrading is one of the biggest pitfalls for many traders. The constant urge to be in the market can lead to impulsive decisions and excessive risk-taking. Develop the patience to wait for your predetermined setup and criteria to be met before entering a trade. Don't force trades or get caught up in fear of missing out. Trading can be mentally and emotionally draining. Make sure to take regular breaks to recharge and avoid burnout. Step away from the screen periodically to clean your mind and regain perspective. Several psychological biases and pitfalls can negatively impact your trading performance. Recognizing and managing this will help you become a more disciplined and successful trader. Confirmation bias is the tendency to seek out and prioritize information that confirms your existing beliefs or positions while dismissing or ignoring contrary evidence. This can lead to blindly holding onto losing positions or doubling down on a failing strategy. Hindsight bias is the inclination to believe that the outcome of an event was predictable all along after the fact. This can cause you to beat yourself up over missed opportunities or poor trades, even though the information available at the time didn't support that level of foresight. The gambler's fallacy is the mistaken belief that if something happens more frequently than normal during a given period, it will happen less frequently in the future, or vice versa. This can lead traders to hold onto losing positions, thinking the market is due for a reversal. The endowment effect is the tendency to overvalue something simply because you own it. this can make it difficult for traders to exit losing positions as they become emotionally attached to their holdings and unwilling to accept a loss. Anchor bias is the tendency to rely too heavily on the one piece of information or reference point when making decisions. In trading, this can manifest as holding onto an arbitrary price target or entry point, even when new information contradicts the original premise. By understanding and actively working to overcome these psychological pitfalls and biases, you will be better equipped to make rational, unemotional trading decisions based on your strategy and risk management rules and not your emotions. Developing the right trading psychology and mindset is an ongoing process, but one that will pay immense dividends in your long-term trading success. Trading is as much a mental game as it is a technical one. Mastering both elements is key to becoming a consistently profitable trader. While most cryptocurrency trading happens on centralized exchanges like Bybit and Binance, decentralized exchanges are an emerging alternative. DEXs are non-custodial, meaning you retain control of your private keys and funds at all times. There is no centralized entity facilitating the trades. Instead, DEXs rely on smart contracts and protocols like automated market makers to enable peer-to-peer trading. Popular DEX platforms include Uniswap, PancakeSwap, and Curve Finance. The main advantages of the DEXs are increased privacy, reduced counterparty risk, and resistance to censorship. However, they can suffer from lower liquidity and higher slippage compared to centralized exchanges. Atomic swaps are a way to exchange one cryptocurrency for another without going through a centralized exchange. They use cryptographic techniques to facilitate peer-to-peer cross-chain trading in a trustless manner. The coins being exchanged are secured by hash time-lock contracts, allowing the swap to complete safely without counterparty risk. While still niche, atomic swaps represent an intriguing area of decentralized trading. Most spot trading on exchanges involves trading actual cryptocurrencies. However, many exchanges also offer margin trading and futures contracts, which are derivatives products that increase leverage and risk. Margin trading allows traders to borrow funds from the exchange to increase their position size, amplifying potential profits but also potential losses. Exchanges typically require maintaining a minimum margin level. If the trader's equity drops too low, the position can be forcefully liquidated. Futures contracts are agreements to buy or sell an asset at a predetermined price at a specific point in the future. Cryptocurrency perpetual futures have no expiry date. Trading futures allows speculation on price movements without owning the underlying asset. However, it involves significant leverage and the risk of being liquidated. While margin trading and futures can potentially boost returns, the increased leverage and complexity make them extremely risky, especially for beginners. An initial coin offering is a way for cryptocurrency projects to raise funds by selling a newly created token, similar to an IPO in the stock market. Early investors receive the tokens, which can appreciate in value if project succeeds. At their peak in 2017-2018, ICOs raised billions for blockchain startups, though the space was rife with scams and failed projects. ICOs have declined in prominence, with many jurisdictions increasing regulation. However, many projects still conduct token sales to bootstrap their ecosystems and incentivize adoption. For example, participating in quality token sales can allow getting in early on potentially successful projects. However, there are major risks, including lack of regulation, risk of failure, and the challenges assessing the technical merits and long-term viability of projects. Thorough research on team, use cases, tokenomics, and legal considerations is imperative before investing. Cryptocurrency lending platforms like Compound and Celsius allow cryptocurrency holders to lend out their assets and earn interest on them. Borrowers put up collateral and take out loans, paying variable interest rates set by algorithmic money markets. Crypto lending is a rapidly growing part of the decentralized finance ecosystem. There are significant risks, like smart contract vulnerabilities and the lack of insurance or deposit guarantees. However, lending assets out can provide passive income streams for crypto holders. Staking refers to the process where cryptocurrency owners can lock up or stake some of their holdings to help validate transactions on a proof-of-stake blockchain network. In return, they earn staking rewards in the form of newly minted coins. Staking allows earning yield on holdings while contributing to network security. Major proof-of-stake networks that support staking include Ethereum, Solana, Avalanche, Cosmos, and Polkadot. Risks include illiquidity of staked funds, slashing penalties for poor validator behavior, and the technicalities involved in running validator nodes. However, staking is an increasingly popular way to earn returns on crypto assets. These advanced areas, like DEXs, margin trading, ICOs, lending, and staking, showcase the innovative capabilities enabled by blockchain and cryptocurrency technology. While involving increased complexity and risk, they open up new financial possibilities and revenue streams for crypto traders willing to explore them carefully. Congratulations! You've made it through Ultimate Crypto Trading course and taken a major first step towards becoming a successful cryptocurrency trader. Crypto trading is an incredibly deep field with new developments and innovations emerging constantly. So use this as your foundation, but don't stop here. Keep studying the markets, logging screen time, remaining humble, and always working to sharpen your edge as a trader. Subscribe to trading channels. Join communities, analyze your winners and losers, immerse yourself fully. The crypto markets operate 24/7 and there is always more to learn. But you are now armed with the fundamentals to start your journey towards profitable crypto trading. From here, it's up to you to take action, gain experience, and mold yourself into the trader you want to become. I wish you the very best of luck, and may the markets be ever in your favor. Get out there and start trading cryptocurrencies like a pro.